All right. Good afternoon, everyone, and welcome to Sales Tax Basics. I'm Cindy Nellis. I'm with the Penn West Clarion Small Business Development Center. We're happy that you are with us today. Sorry that we are getting started a little bit later, but we'll make sure that we have all of your questions answered before the end of today. Just to get started, this particular webinar, we know that many of you are getting your businesses set up and ready to go. And we want to make sure that you have a basic knowledge of Pennsylvania sales tax, who needs to be registered to collect, what items are taxable, what does sales tax need to be, when does sales tax need to be charged, where do you file and pay, and how to keep those proper records. Today, you will also learn about exemptions, use tax, and resources to help you every step of the way as your business grows. And we have a great presenter, quite an expert, and we have a team of experts with us as well. So the Pennsylvania Small Business Development Center, we have partnered with the Department of Revenue to bring you a tax series. Today, we are presenting the third topic in our four-part series. And so as you see these topics, I hope that you plan to join us for other webinars in the future months. Following today, you will get information about the rest of these webinars. If you have a question for our experts, we just ask that you use the Q&A. If you have a question for me, your host here at the Small Business Development Center, we ask that you use the chat box. I want to start to talk to you a little bit about the Small Business Development Center. We are a organization, grant-funded program that has a mission to help businesses start, grow, and succeed. We do that through one-on-one business consulting services primarily. We're here to provide you education, information, tools, and resources to help you make better business decisions. Our one-on-one business consulting services are provided at no cost, and it's confidential. Those that we work with are prospective entrepreneurs, those looking to start a business, as well as existing small business owners. And to us, a small business is generally defined as a business with less than 500 employees. We also spend our time providing training. It's a part of our marketing. And so after today, you're going to get a list or a link to all of the different webinars that the Small Business Development Center program across Pennsylvania offers. We're here to, as I mentioned, we're here to provide information. We do have a lot of great resources, both locally at our centers, across our statewide network, as well as across the nation, because we are a program, a national program with resources all over the country. This is a map, so you can see which SBDC is closest to you. We are a network of 15 centers, all located at institutions of higher education. They invest in our program, as well as we receive funding from the Small Business Administration on a federal level, and through the line item in the state governor's budget called Partnership for Regional Economic Performance. After today, you will get information about how to connect with the Small Business Development Center if you haven't already. All you need to do is request our assistance. You do that through an online request for consulting form. We're also going to provide to you the slides that you see today, as well as any additional resources that that partner up and align with what you hear today. So plan to hear from me within the next 24 hours with information to follow up from today. We are recording today's webinar, and we will be providing that recording as well. So today, our speaker is Ben Turek. Ben is a certified public accountant and has been with the Pennsylvania Department of Revenue Bureau of Audits for the last 15 years. He's had various roles from trainee auditor, supervisor, tax specialist, and now program administrator in the areas of corporate net income, sales and use, and personal income tax. In these positions, he has had a wide range of tax and audit issues and is now responsible for developing and implementing audit procedures and tax policy, primarily in sales and use tax. So with that, I will stop sharing, Ben, and I will turn it over to you.
Great, thanks, Cindy. Let me get the screen shared here.
Super, looks good to me.
All right. Well, hello and welcome everybody to the new business series presented by the PA Department of Revenue. As Cindy said, my name is Ben Turek and I am the Revenue Tax Audit Program Administrator for the Sales and Use and Personal Income Tax Division in the Department's Bureau of Audits. First, I want to thank you all for joining us today and for wanting to learn more about how to properly collect and remit sales tax. One thing we do want to emphasize in our presentation series is the cost of non-compliance far outweighs the cost of compliance. So today we're going to cover a wide range of information relating to sales tax and the nuances that go into it. We will be defining exactly what sales tax is according to the Commonwealth of Pennsylvania and how local sales tax is applied. With that, we will talk about what items are taxable, including tangible personal property, services to tangible personal property, and some services that were enumerated as taxable as well. We will also clarify who must collect PA sales tax, as well as what qualifies as nexus. We will also go over how to register for a license, how to calculate the amount of sales tax to collect, as well as how to report and pay to the Commonwealth. Next, we will quickly go over exemptions and who or what they apply to. We are also going to highlight use tax and when it needs paid. And finally, we will wrap this module up by going over what resources are available to help you should you have questions or need further assistance. So what is sales tax? Sales tax is a 6% tax on sales within the Commonwealth of tangible personal property, services to tangible personal property, and certain enumerated services. We will talk about each of these points individually, but before we do, let's explain what we mean by a sale within this Commonwealth. If you buy an item at retail and the item is delivered to, used, or consumed in Pennsylvania, then the sale occurred in this Commonwealth. If a business sells and delivers an item to an out-of-state location, then the sale was not made in Pennsylvania and is not subject to Pennsylvania sales tax. As you can see on the map, Allegheny County shows 7% and Philadelphia shows 8%. This is because of a local sales tax component. During the 1990s, the Pennsylvania legislature passed a new law imposing a local sales and use tax on certain counties. This tax was imposed in addition to state sales tax in Allegheny County and the city of Philadelphia. The rate in Allegheny County is 1% and Philadelphia is 2%. These taxes are deposited into a fund dedicated to pay for specific needs of those jurisdictions. The rules are the same, except that the local tax is based on the place of sale and not the delivery. For instance, if I buy a meal in Philadelphia, I will be charged a total of 8% state and local sales tax on the meal. If I live in Montgomery County and order furniture from a Philadelphia store, the additional 2% local sales tax will still be added based on the location of the store where I made my purchase. Now that you're a little more familiar with what exactly sales tax is, let's review the individual taxable components. For tangible personal property, what we're talking about, tangible typically means something material or physical. Tangible personal property is generally physical property that can be touched, such as furniture, clothing, and vehicles. However, there are items that cannot be felt but are still considered as tangible property. These items include things like electronically delivered software. It is distinct from real property or real estate in that it can be moved from one location to another, while real property is permanently attached to a single location. This slide shows a list of some taxable items in the law. Some of these are clearly tangible, such as greeting cards, helmets, and books, while some, like telecommunications, are a bit less black and white. There are also examples here on the screen that are not specifically in the law, but they help to illustrate what kinds of items constitute tangible personal property. You can see how wide-ranging these items are. If you buy any of these items or similar items in Pennsylvania, or have them delivered into Pennsylvania, they are taxable tangible personal property. We do have a more complete listing available. That's available in the REV 717, which is our retailer's information guide. There are certain items of which sales tax is excluded per the sales tax law. The exclusions include the following: wrapping materials that are needed to deliver property, such as bubble wrap, pallets used to transport goods, shrink wrap, and so on. Essentially anything that is wrapped with a package or used to deliver a package is considered exempt if it's being purchased for resale. Grocery store food, unless it's considered ready-to-eat food, such as sandwiches from a deli, are excluded. Clothing that is considered everyday wear. So everyday wear items are articles of clothing that are not required as a condition of your employment, like a uniform, and considered to be your regular clothes. These everyday wear items are not subject to tax. Caskets that funeral directors use in conjunction with funeral services are exempt from both sales and use tax. Regular unflavored water, including mineral waters, are also exempt. And then we have sales for resale. This is a big one for many businesses. Industries like department stores, grocery stores, automobile dealers, and the like are in the business of buying goods and reselling the same goods. In Pennsylvania, if the inventory or goods that you are buying is for resale, you are not required to pay sales tax, given that you will charge the tax to the end consumer. While it's not listed on this slide, one of my favorite exclusions in the tax code is brook trout, rainbow trout, and brown trout. It's just one of those goofy things that are out there. They're the only fish that you can purchase exempt unless they are for resale. Sales tax is also imposed on services done to tangible personal property. Basically, the rule is if the item that needs serviced is taxable, then the service to that property itself is also taxable. For example, if my watch breaks and I take it to a jeweler to have it repaired, that transaction is subject to sales tax. Since watches are subject to sales tax or taxable, then the repair service needed to fix my watch is also subject to sales tax. This slide shows some examples of services that are taxable, which may help you to better understand this concept. Take note of the first item, wrapping or packaging tangible personal property. Now, I know I just used wrapping materials as an example of an exempt item. This is considered taxable because we are not mentioning it being used specifically by the seller to wrap or package items that are incidental to the delivery. So this example on this slide is referring to the service of wrapping tangible personal property, such as gift wrapping. Enumerated services are those services that are specifically taxed in the tax reform code. These are not tied to tangible personal property, but are specifically identified for taxation by legislation. This slide lists some examples of the enumerated taxable services. These can get very involved, and some have some special rules on how to determine taxability. All of these items are specifically outlined in the REV 717 that I mentioned earlier. So we recommend you check that out if you are providing any of these services. Now that you know what sales tax is and some examples of items and services where sales tax is applicable, let's dive into who should be collecting Pennsylvania sales tax. The Tax Reform Code states every person who maintains a place of business in the Commonwealth to sell tangible personal property or to perform taxable services is required to be licensed for and to collect sales tax from its customers. In other words, the law requires Pennsylvania businesses to collect the tax from the consumer at the time of sale. What it means to maintain a place of business has changed over the last several years. One of those is physical presence. For an entity to have physical presence, it means exactly that. To fall under this category, a business must have taxable sales and have some type of physical location like an office or place of business, an employee, including a representative and independent contractor, stored inventory, rented or leased properties or tangible goods, or they make deliveries to a PA address. Meeting the qualifiers for physical presence means that the business would be maintaining a place of business in this Commonwealth. This is going to apply to most of you. For the majority of you attending today, you will have a physical presence in Pennsylvania. Let's quickly revisit bullet point number 3, goods or inventory in a warehouse. Under Pennsylvania law, inventory stored in a warehouse, fulfillment center, or any location within Pennsylvania creates a physical presence with the Commonwealth. This means that retailers who have inventory stored within Pennsylvania are required to register to collect and remit Pennsylvania sales tax on any sales made by the retailer directly to Pennsylvania customers. We are highlighting this one specifically because many people who sell online are not aware of this. Even if you sell through a marketplace facilitator and the goods are stored in one of their warehouses, but the end consumer is a PA resident, you have a physical presence in the state. Speaking of online sales, this is a perfect segue to transition into economic presence. So even though an entity might not have a physical presence in Pennsylvania, they may have what's called economic presence. The Tax Reform Code defines maintaining a place of business within this Commonwealth to include having any contact within this Commonwealth, which would allow the Commonwealth to require a person to collect and remit under the Constitution of the United States. This statement is referring to economic presence. If a business makes $100,000 or more in annual Pennsylvania gross sales, then that business would be considered to have economic presence, and they must collect and remit Pennsylvania sales tax. In 2018, the Wayfair versus South Dakota decision opened up the legal door to expand the concept of nexus beyond mere physical presence. In the Wayfair decision, the Supreme Court ruled that as long as the state had a uniform tax rate, did not apply the new law retroactively, and provided some sort of administrative assistance in making tax determinations and filing, economic presence is an acceptable standard in making businesses collect sales tax. The effect was to level the playing field for all businesses. In short, what we are talking about here is out-of-state businesses that sell to Pennsylvania customers and establishing consistency in the requirement to collect and remit sales tax. Previously, when nexus was determined solely by physical presence, these businesses would have a huge advantage over PA brick and mortar locations as they were not held responsible for the collection and remittance of sales tax. With the new law, out-of-state businesses are now treated similarly to Pennsylvania business locations if they make over $100,000 in gross sales into Pennsylvania annually. Use the word nexus a lot here, so let's quickly discuss what that means. Nexus is when a business has either a physical presence or an economic presence within Pennsylvania. Sales tax nexus is just a fancy way of saying significant presence in a state. If a business is considered to have nexus in Pennsylvania by having either a physical presence or an economic presence, then they must collect sales tax on all taxable sales to Pennsylvania customers. So So now that we know who needs to collect sales tax, let's discuss how to go about registering for a sales tax license. In order to collect sales tax, you must have a license issued by the Pennsylvania Department of Revenue. The license performs many functions, including demonstrating to the public that a business is a duly licensed agent to collect sales tax on behalf of the Commonwealth. It should be noted that if a business has collected sales tax without a proper license, they should coordinate with the Commonwealth to remit the money immediately, which means within 30 days of collecting it. To register and obtain a license, you need to complete the PA Online Business Tax Registration application. If you have no pre-existing business tax accounts, you can use the business registration hyperlink right from the MyPath homepage without logging into your profile. If you have any pre-existing business accounts and simply need to add sales and use tax, you should log into your profile and use the business registration hyperlink there. The reason for this is that by going through your logged in profile, you won't need to refill in your business's information for the application. Please be aware that citations are issued for operating a business without a valid sales tax license. Under Pennsylvania law, sales tax monies collected by a business on behalf of the Commonwealth are defined as trust fund money. The money does not belong to the business, it belongs to the Commonwealth. It must be handled according to the law and to department regulations. A business must meet the timely reporting and filing requirements established by the Tax Reform Code. Proper handling of trust fund money helps secure the success of the business by avoiding costly penalties. If you are an entirely new business to Pennsylvania, we recommend that you visit www.business.pa.gov for all of your registration needs. This one-stop shop website was established to help new businesses get up and running beyond just setting up their tax accounts. Now that you signed up for your sales tax license and are ready to make some sales, you will need to know how to collect and remit the tax to the department. Of course, the first step in collecting sales tax is knowing the amount that needs to be collected. As mentioned previously, sales tax is a 6% of the total purchase price. That includes warranties, which represent prepaid taxable services to taxable tangible personal property, delivery, and other services. An example of another type of service that would be included in the purchase price would be the charge for car detailing included with the purchase price of an automobile. When it comes to deductions, the basic rule is any cost a business incurs in selling a taxable good or service when passed on to the purchaser is considered to be part of the taxable purchase. For example, if you take a look at your phone bill, you may see a line item called universal service. This is a charge that telecommunication providers may add to your bill to recover the cost of their federally mandated contributions to the universal fund. It is a cost of doing business for them, and they may elect whether to bill their customers for this or not. With that passing on of that universal service fee, that does become taxable for sales tax. Amounts representing on-the-spot cash discounts, employee discounts, volume discounts, store discounts such as buy one, get one free, wholesalers or trade discounts, and store or manufacturer coupons shall establish a new purchase price if both the item and the coupon are described on the invoice or cash register tape. There was a recent court case that was Myers versus Commonwealth that affected how general discounts are handled. The court found that the regulation does not require the coupon to relate to a particular taxable item. In order to reduce the purchase, only the item and coupon be described on the receipt and invoice. As the court noted, if all items on the invoice or receipt are subject to tax, then it's reasonable to determine the purchase price is being reduced by the coupon. Conversely, when all items are not taxable and the coupons do not identify the taxable items, the description is inadequate and the amount of the coupon cannot reduce the purchase price. To put it simply, in order to reduce the taxable purchase price, the receipt must identify what products the discount applies to. Sales tax returns and payments must be filed electronically. There are 3 methods in which you can do this: online, over the phone for a period of time here, or using a third-party vendor. We strongly encourage you to use our online MindPath portal to file and pay your sales tax amounts. Not only are you able to file and pay for the current year, but you're also able to view previously filed returns, access notices that have been issued from both PATH and eTides, request statements of account that are available immediately after you submit your request, as well as send messages to the department and more. Another very important function is that you can grant permission to others like your CPA or bookkeeper to also view information regarding your returns. You can access the MyPath portal at www.mypath.pa.us, or simply visit revenue.pa.gov and click on the icon that says MyPath right from the homepage. Please note that you must create an account to utilize this service. The telefile system can be accessed by calling 1-800-748-8299. Pre-registration is not necessary to use telefile, but you will be required to enter any 2 of the following identifiers: your 8-digit license ID number, your federal employer identification number, social security number, or 10-digit revenue ID, and the period ending date for the period you wish to file. Lastly, the department has third-party vendors who will provide e-filing software for those taxpayers who do not wish to use the department's e-filing options. A list of approved software vendors is available at the department's website at www.revenue.pa.gov. Some important things to remember: the PA-3 forms, which are the sales and use tax returns, are not available for download from the internet, and the use of other tax forms could result in non-filer notification and/or the misapplication of the tax payment. Per regulation, taxpayers who are making payments of $1,000 or more must remit them through electronic funds transfer, also known as EFT. Failure to comply with the EFT remittance requirements may result in an assessment of a penalty equal to 3% of the total tax due, not to exceed $500. The penalty may be imposed on all payments of $1,000 or more that are not presented to the Department of Revenue by an approved payment method. So if every quarter you are sending in a check for over $1,000, you are going to get hit with a penalty for every quarter that you do that. When you initially register for a sales tax license, your filing frequency will automatically be set as quarterly. Near the end of every year, the Department of Revenue reviews the average of the current year first and second quarter sales, as well as the prior year third and fourth quarter sales, to determine if the filing frequency needs adjusted. Semi-annual filers are those who have an actual tax liability of $300 or less annually. Semi-annual returns are due August 20th for the January to June period, and February 20th for the July to December period. Quarterly filers are those with actual tax liabilities that are less than $600 per quarter, but greater than $300 annually. Quarterly returns are due the 20th day of the month following the end of each calendar quarter. So that means that the quarterly returns are due April, July, October, and January 20th. Monthly filers are those whose actual tax liability is less than $25,000, but greater than $600 per quarter. Monthly returns are due the 20th day of the month following the end of each calendar month. This is a lot of information being thrown at you, but thankfully the department puts out a yearly due date calendar called the REV 819, which is broken down by frequency to help you remember when your filing due dates are. You may find this form on the Department of Revenue's website. If your actual tax liability is $25,000 or more per quarter, you may be required to remit what we call accelerated sales tax prepayments. These are basically advanced tax payments made for those who have a high tax liability for the year. We will have more information available on accelerated sales tax payments in the future, but we have found that this is typically not something a new business needs to be concerned about right away. The Department of Revenue offers vendor discounts for timely filed returns and payments. This discount is limited to a flat rate depending on your filing frequency or 1% of tax collected, whichever is the lesser of the two. If you collect tax on an item that you previously paid sales tax on, you can claim a credit for the sales tax paid when you originally purchased the item. An example of this would be Ted owns an aluminum siding company, which makes half of its revenue in retail sales and the other half in contract work. Ted enters a construction contract to install 1,000 square feet of aluminum siding on customer A's house. Ted purchases the 1,000 square feet of aluminum siding at $3 per square foot, and he correctly pays $180 in sales tax on the $3,000 purchase price because he anticipates that he will be the ultimate consumer of the siding. Before the contract is performed, Ted decides to sell the aluminum siding at retail for $5 per square foot to customer B. At the time of the sale, he properly collects $300 sales tax from the purchaser who bought the aluminum for $5,000. In reporting the $300 in tax, which he has collected from customer B, Ted is permitted to claim a credit of $180 for the sales tax which he had previously paid on his purchase of the aluminum siding. This is called a taxes paid, purchases resold credit, or we abbreviate it as TPPR credit. This credit shall be taken within 3 years of the date of the original payment of tax on which the item has been sold. It is important to remember that this credit is not for those items that are purchased with the intent to resale. We will talk about exemption certificates in a little, which will cover those scenarios. Let's recap some of the general rules that we just went over. First, filing and remittance occurs at different intervals determined by the department. You can either be a monthly, quarterly, or semi-annual filer, depending on the size or the sales volume of your business. First-time filers will always be set up as quarterly until the department has a chance to review your sales activity to determine if the frequency needs adjusted. The due dates will always be the 20th of the month following the last day of the reporting period, except for those semi-annual filers, which is the 20th of the month of the second month following the reporting period. Again, Form REV 819, which is available on our website, is there to help you remember when your due dates are based on your designated filing frequency. Local and state sales tax are filed together on one report. One thing that a lot of people are not aware of, but is very important, is that even if you have no sales for a certain period, you are still required to file a zero return. Think of this as an informational return, letting the department know that you had no sales for that period. You must do this in order to stay compliant with the department. No discount is granted on returns that are filed late. However, penalty and interest will be added to those late filings, as well as late payments. For interest, for any late payment of tax, interest is calculated on a daily basis. It is calculated by taking the amount of tax due and multiplying it by the number of days past the original due date, then by the daily interest rate. The annual interest rates varies by year, so you will want to use the REV 1611 to find out more information regarding how this is calculated. We will talk about this a little bit more later on in the presentation. The penalty for past due filing of sales tax return is 5% per month from the date that the return is due until the date is filed, not to exceed 25%. If an underpayment penalty is warranted, it is imposed at a rate of 3% a month on the unpaid tax balance from the date filed to the date paid, not to exceed 18%. In no case should the additional penalty be less than $2. If the proper tax, interest, and additions are not remitted, the department will make an assessment. The next area we will talk about is exemptions. Unlike exclusions, which are usually items never subject to sales tax, an exemption is a situational and dependent on who purchases the item and how the item is used. Pennsylvania law allows businesses to claim an exemption from sales tax for several different reasons. The exemptions are centered on certain business processes, and their taxability depends on who bought the item and how it is used. To claim an exemption from sales tax, you must complete the REV 1220, the PA exemption certificate, and disclose a valid basis for exemption. Keep in mind that the purchases must be consistent with the exemption reason being claimed. This form must be filled out to completion. You must select if the exemption is to be used for one or multiple transactions. Fill in the name and address for both the seller and the purchaser, and select the exemption being claimed. Additionally, the burden of proof falls on the shoulders of the person claiming the exemption. You must supply supporting documentation when appropriate to support your exemption claim. If the form is missing any of this information or the purchaser's signature, the seller has a right to reject the exemption certificate and charge tax, as it will be considered incomplete. Now let's go over some of the reasons that you may claim an exemption in Pennsylvania. The first reason you may qualify for an exemption is if you are an exempt entity, such as a government organization or qualified nonprofit. Items purchased by state and federal agencies, as well as Pennsylvania school districts, are exempt from sales tax in most cases. Catholic and private schools will receive a 76 number to claim an exemption. Regarding construction contracts, the exemption is limited to building machinery and equipment and not the governmental organization. For nonprofit organizations or institutions of purely public charities, there is a limited exemption on purchases. Examples of institutions of purely public charities include not-for-profit hospitals, volunteer fire companies, and churches. Organizations that qualify under this category are given a 75 sales number by the department. When we say limited exemptions, we mean that there are certain requirements that must be met to consider their purchase exempt. The items or services purchased by these entities must be directly used in their charitable purchases. For example, let's say a church purchases a lawnmower to use for maintenance of the property. They will need to pay sales tax on this purchase because the lawnmower is not directly used in their charitable purpose. Additionally, all exempt items must be purchased in the name of and from the funds of the exempt organization. Please note that if you have a 501c3 status with the IRS, you do not automatically qualify for a sales and use tax exemption, and you must file an application, which is the REV 72, with the department to determine your state exemption eligibility. If you are a business operating in a Keystone Opportunity Zone, Strategic Improvement Zone, or a similarly designated state economic zone, you are given a sales tax exemption on goods and services used exclusively in the zone. Purchases made for items or services used by the business outside of those areas will need to include sales tax. Businesses qualifying for this exemption will receive a 72 number from the Department of Community and Economic Development. Next, you will want to consider how the item is being used. If an item is being used directly and predominantly by a business in an exempt business process, it will qualify for an exemption as well. Exempt businesses processes include manufacturing, mining, dairying, farming, shipbuilding, and timbering. Looking at this, direct and predominant use means that the item is used directly in the exempt business process over 50% of the time. An example of this is a manufacturing entity purchases a forklift that is used in pre-production activities like moving raw materials, production activities like moving work in process from one workstation to another, and post-production activities like loading finishing goods onto a truck. For the forklift to be exempt from sales tax, it must be used over 50% of the time in those actual production activities. If it is used more than 50% of the time in activities that are not considered part of the actual manufacturing process, then there is no exemption. And finally, if you are buying goods and services for resale, you can complete the REV 1220 to receive an exemption on the items upon your initial purchase, since you will be collecting the tax from your customer. Most of the time, this applies to retailers or wholesalers who purchase items for the sole purpose of resale. If you are deemed a retailer or wholesaler, you will be issued an 8-digit number by the Department of Revenue. So an example of this is I own a car repair shop, and I'm working on a car for a customer that needs a new part. I order the part from a place like Napa or AutoZone. The part is then being resold to the owner of the car once it is installed. Since I am purchasing the part for the sole purpose of reselling to my customer, I would supply the REV 1220 to Napa or AutoZone so that I would not pay sales tax at the time of my purchase. Earlier, we talked about the taxes paid purchases resold credit. That credit is claimed by those businesses who are buying items without the intent to resell and later end up doing so. Unless, of course, you are in industries specifically identified in the law, such as barbers and beauticians. The difference between this and the TPPR credit is that in this scenario, I am not using the part for my use in my shop, and therefore I should not be paying the tax upfront since I am intending to collect it from my customer. As a note, we discussed barbers and beauticians. They are required to pay sales tax on all purchases of equipment, materials, or supplies, regardless whether the property is purchased for use in the performance of the services or for resale. If you fall in this category, you must pay the sales tax up front and then claim the tax paid purchases resold credit on the sales and use tax return when those items are actually sold. When a seller does not charge PA sales tax on a taxable item to a Pennsylvania purchaser for any reason other than a valid exemption, it then becomes the responsibility of the purchaser to pay the tax directly to the Commonwealth. This is called use tax. Use tax is the counterpart to sales tax, and these situations most likely occur when the seller has no nexus in our state. As we just stated, use tax is sales tax not collected by the vendor or seller at the time of the purchase, and then is the responsibility of the consumer. Examples of when use tax is due is if your business makes purchases of taxable items over the internet through toll-free numbers, from mail order catalogs, and from out-of-state locations that are not charging PA sales tax. You, as a purchaser located in PA, must essentially make a payment to cover the amount of sales tax that should have been included with your total at the time of purchase. This is the purpose of sales tax, use tax. The tax rate is the same as sales tax, which is 6% for state, plus 1% local tax for items purchased in, delivered to, or used in Allegheny County, or 2% if the items are purchased in, delivered, or used in Philadelphia. Many businesses believe they save money by making tax-free purchases from out-of-state vendors, unaware that these transactions are often assessed upon audit by the department. Since assessments include interest and penalty on top of the tax, businesses in these situations have increased operational costs by not voluntarily addressing those use tax obligations. Businesses who are registered for sales tax may remit use tax as part of their sales tax return. If you are familiar with the term return, this would go on line 6. Businesses with ongoing use tax liabilities who are not registered for sales tax should apply to the Department for Sales and Use Tax account through MyPath system, which we discussed earlier. Businesses with infrequent use tax liabilities may use the department's online use tax payment option right from the MyPath homepage, which again is a non-logged in function. Individuals or sole proprietorships may also use line 25 of their PA40 to pay use tax. Sales tax is one of the most, if not the most complicated taxes for taxpayers to deal with. I know we've thrown a lot of information at you today about an already very nuanced topic. So let's discuss some of the resources that you can refer to, which are available on our website. The majority of these will be the same resources that we had mentioned earlier, and will serve as reminders as to what's available. We've mentioned this one a few times throughout this presentation. The REV 717 Retailer's Information Booklet is a great guide for determining what goods and services are subject to sales tax. It also provides some information on some of the other topics we discussed here today as well, like petitions for reassessments, construction contracts, and motor vehicle lease tax rates, and more. Next is the REV 588, Starting a Business in Pennsylvania, a guide to Pennsylvania taxes. This is a fantastic resource that touches on all of the basics for new business owners. This guide includes information for sales tax, as well as registration, employer withholding tax, and other items that go into owning and operating a compliant Pennsylvania business. The REV 819, which we talked about when discussing due dates, is the schedule put out each year that breaks down filing and payment due dates by filing frequency. The 2023 schedule is published and available under forms for businesses, sales and use tax, and hotel occupancy tax forms from the department's website. Again, this schedule outlines all of the period end dates and the due dates, and even provides more information on the accelerated sales tax prepayment requirements. The REV 1611 is the form used to calculate the interest on all taxes due after January 1st, 1982. Earlier, we mentioned that interest is calculated on a daily basis. It is calculated by taking the amount of tax due and multiplying it by the number of days past the original due date, and then by the daily interest rate. The daily interest rate is derived by dividing the annual interest rate by 365 days. The interest rate for any given year is established by the U.S. Treasury Secretary and is effective on January 1st of each year. For example, for 2021, the rate is 7% annually, or 0.000192% per day. We strongly encourage all of our customers to use our online customer service center. To do this, you can visit the website listed on the screen, or click on the customer service icon directly from the department's homepage. Here you can find thousands of answers to frequently asked questions. These responses are updated regularly to ensure that the information you are receiving is accurate and relevant. If you're not able to find an answer to your question through the frequently asked questions or general website resources, you also have the option to submit a question to the department. This feature allows users to submit either a general taxability question or a more pointed question regarding a specific scenario to a trained representative who specializes in sales tax. We will review your submission and respond to it within 72 business hours in a process that is similar to receiving an email. Least we forget the Customer Experience Center call center. Here you will be able to speak with a representative skilled in whichever particular tax type you pick from the menu prompt. Regular business hours are Monday through Friday, 8 a.m. to 5 p.m. If sitting on hold waiting in line is not your thing, we do have an option to schedule a call. As explained earlier, this option allows you to schedule a date and time that works best for you, and one of our representatives will call you directly to discuss whatever your question is. Please be aware that on observed holidays, our offices are closed and you will not be able to schedule a call for those days. You can find this option by clicking on the schedule call icon directly from the department's homepage. Well, that concludes our presentation for today on the sales tax basics. We have a few minutes left. Looks like the Q&A is down to none.
Mhm.
So does anybody have any other questions before we wrap things up for today?
So I do see one more question answered, Ben, or question asked. I also noted in the chat that if you have a question and would like to ask it directly, I'm happy to unmute you. I just need to know that is something that you would like. Sometimes you have a question that is too hard to type out. Although Ben, your team's been doing a fabulous job with answering questions today. But if you want to ask it directly, I'm happy to unmute you before we finish because we do have just a few moments. A few reminders. When we finish today, I will be sending you a link to an evaluation for you to give us information back about what you liked, maybe what you wanted covered and didn't see it today, or maybe something completely different, what you're looking for training on. Again, while we wait, I am going to do one quick question poll, and that is up right now. Just want some quick feedback on today's webinar. In response to the question regarding a copy of the recording, yes, we will be sending out both my slide presentation and Ben's slide presentation along with the recording to today's webinar, probably within the next 24 hours. It just takes a little bit of time to prepare the recording to share it. So that will be coming for sure, along with any additional resources. And of course, the flyer that shows you what upcoming webinars we have over the next few months. So it looks
Right, Cindy,
like
we do have two people that would like to be
Oh.
unmuted to ask a question. We have
Okay.
a Lisa and a Lori.
Okay, I'm not sure why that changed. Sure. Okay, Lisa and Lori. So it looks like let me get back there. All right, let me get to Lisa.
Glad you're doing it because I have no idea how to unmute somebody from here.
All right. Okay, Lisa, I'm going to let you talk.
Hi,
Hi
Lisa.
there, can you hear me okay?
Yes,
We can.
ma'am.
Great. All right, Ben, first off, thank you very much. It was a lot of great information that you provided. I'm still a little confused. I see Maureen asked a question, but I'm confused between the sales for resale exemption versus the TPPR credits.
Sure.
So I have a stained glass business. So if I'm buying glass materials from a Pennsylvania business and then combining those materials to then make my products, does that qualify me for that initial sales tax exemption from the shop where I'm buying materials? Or would I then claim the TPR credit?
So A lot of it comes down to the intention. So are you installing those stained glass windows, or do you just sell them outright?
I'd be, well, or little items as well, just I'd be selling them resale.
Okay, yeah. So, if you're not intending to install stained glass windows yourself, the purchasing exempt for resale would be the applicable way to do it. The TPPR credit would be more for, a business that's really intending to install something or use it themselves, and then they end up not doing it. But if you're going into the transaction knowing that you're purchasing that item to sell it to a customer, then the providing the exemption certificate for resale would be what would be appropriate.
Okay, and that would also apply to any tools that I would purchase to use my business, like grinders or glass cutters or
Well,
soldering.
so it would be a little bit different for that. That would be something that you would purchase exempt for manufacturing activity. So you wouldn't want to claim resale on the tools
Right.
that you're purchasing. But if you're taking lead, and I don't know if you can use lead anymore, but whatever it is that you're actually making the stained glass products out of, you would be able to purchase those tools exempt for manufacturing, not for resale. So it's the same form, just a little bit of a distinction on what you're claiming for the actual exemption.
Okay, thank you for clarifying.
No problem.
Thanks, Lisa. Lori, I'm going to unmute you now.
Great, thank you. Can you hear me?
Yes.
Okay, awesome. Thanks to the SBDC for having these, hosting these, and thanks very much, Ben and Department of Revenue and everybody who's been answering questions. I have a feeling I'm just going to have to reach out and get some individual support because it's very overwhelming.
That's something that you're certainly welcome to do. Cindy has my email address. So
Okay.
if you reach out to her, she can share that with you.
So just to kind of repeat and confirm, so if we are selling products within PA, obviously we're going to charge the sales tax because it's a Pennsylvania sales tax. But if our items that we're selling are going outside of PA, technically we're not charging sales tax to them because it's not within PA, which means we should be paying sales tax if we're buying it because we're not charging it. Well, see, we don't know where it's going to go, right? If it's going to be in state or out of state.
So if you are purchasing items to sell to your customers, whether they're located inside the Commonwealth or outside of the Commonwealth, you're still entitled to purchase those items exempt from tax. So the fact that you might not collect tax on the sale of it when it's delivered out of state has nothing to do with your ability to claim the exemption when you purchase those items for resale.
Okay.
So that's not going to be a difference for you, whether you end up collecting tax on it in the end when you sell it. If it's being purchased for resale to another customer, then you are allowed to purchase it exempt from tax.
Okay.
One thing I would note for you is that most of the other states have enacted an economic presence standard as well. So that's just something to be aware of. So you don't have to collect a Pennsylvania tax on those transactions, but you should review what you're selling into those other states to see if you might meet their economic nexus threshold as well, because you may be
And then have to collect their tax.
Correct.
Okay.
Most of them have set it around $100,000. There are some resources that are available out there that can help you identify what those are. So if you just go out and you do a Google search of economic nexus thresholds by state,
Okay.
that should give you an idea of what you have to do. We can't really tell you what those other state requirements actually
Right.
are. Just something to be aware of.
Okay, great. And then one other question. So I understand, or I had got information from somewhere, I don't remember where, about PA sales tax reciprocity.
Mhm.
with 6 different states. So Indiana, Maryland, New Jersey, Ohio, Virginia, and West Virginia. So does that mean if my customers are in any of those 6, I'm supposed to charge them PA sales tax, or where does that sales tax reciprocity come in for collecting or charging tax?
Yeah, so the reciprocity that you mentioned probably actually applies more to personal income tax, so like employer withholding,
Oh,
not the
okay.
sales tax. So we do have reciprocal agreements with those states. There's also Indiana that's in there, although it's not a neighbor state. There, at a time, steel mills where employees were going back and forth between PA and Gary, Indiana. So we did have reciprocal agreements with those, so that if you had an employee of the state that worked in one of those states, we had a reciprocal agreement with that concerning personal income tax. There are reciprocity concerns with other states for sales tax, but it's more if you purchase something out of state and then bring it into Pennsylvania. So if you are selling a product to one of those states, again, there's no Pennsylvania tax that's due on that transaction.
Okay.
And unless you meet the economic thresholds that were set by those states, you would be under no requirement to collect that other state's tax as well.
Okay. Okay. All right. Thank you very much. Thanks for offering the resources as well. And I'm really glad we're going to be able to get the slides and the review, because yeah, I'm going to have to listen to it again. But thanks so much. I appreciate your time, and I hope everybody has a blessed day.
Thank you. So Bennett, looks like the question asked in the chat seems like Nick did answer it.
Okay.
So I think we're good. I guess I will say to everyone, if you do want to ask a specific question to Ben, I'd be happy to share his email address as well. So with that, we are over time. And Ben, I would just like to say thank you to you, to your colleagues there, Nick and Eric, for joining us. And we look forward to having you join us next month for withholding basics on August 9th. And you'll be getting information about that. So thanks, everyone. Have a great day and a great week, and we'll see you next month. Thank you.
Thank you.